Warren Buffett is often regarded as the greatest investor in history. If you had invested just $1,000 in his company at the very beginning, today that investment would be worth over $30 million. That kind of return sounds almost impossible. But how did Buffett manage to achieve this? The secret lies in his deep understanding of investing, principles that most people overlook. But here's the good news. These same principles can be applied to your financial decisions as well. Stay with me because by the end of this video, you'll understand the strategies that made Buffett one of the richest men on the planet. The 3 essential qualities Buffett looks for when hiring people or choosing business leaders. Buffett emphasizes 3 essential qualities: intelligence, the ability to think critically and solve problems; energy, the motivation to take initiative and work hard; integrity, the most important of all. Buffett warns that intelligence and energy without integrity can be dangerous. If someone lacks integrity, you actually want them to be lazy and unmotivated. Otherwise, they'll cause more harm than good. This mindset applies to business, investing, and even personal relationships. Why most investors fail. Buffett has observed a fundamental flaw in human nature. People tend to follow the crowd. During bull markets, investors become overly optimistic. They see rising stock prices, assume the trend will continue, and start investing recklessly, often borrowing money to do so. During market crashes, the opposite happens. Investors panic and pull out their money at the worst possible time. But Buffett doesn't follow the herd. Instead, he sees these moments as opportunities. When everyone else is selling, he buys. When others are greedy, he becomes cautious. This contrarian mindset has allowed him to take advantage of market cycles and build massive wealth. The cigar butt strategy in Buffett's investment evolution. Early in his career, Buffett followed what he called the cigar butt strategy. He looked for undervalued companies, businesses that were struggling but had a little bit of value left in them. It was like finding a discarded cigar with just one good puff left, cheap but not sustainable. While this method made him money, Buffett realized it wasn't the best way to build long-term wealth. Instead, he shifted his strategy. Rather than buying okay businesses at a cheap price, he started buying great businesses at a fair price. He looked for companies with strong brands, loyal customers, and predictable growth. He focused on long-term economic trends instead of short-term price movements. This approach allowed him to scale his investments and build a fortune. The power of understanding your investments. Buffett follows a simple rule. Only invest in businesses that you understand. For example, he can predict that people will still be chewing Wrigley's gum 10 or 20 years from now. But when it comes to complex tech companies or rapidly changing industries, he stays away. His principle: stick to what you know. If you don't fully understand how a company makes money or what its future looks like, you're just gambling, not investing. The biggest investment mistake Buffett regrets. The most costly mistakes Buffett has made aren't investments that lost money. Instead, they are missed opportunities. One example. Years ago, he had the chance to buy Fannie Mae when it was incredibly cheap, but he hesitated. That single decision cost Berkshire Hathaway billions of dollars. These mistakes don't show up on financial statements, but Buffett knows their real cost. His lesson? When a great opportunity presents itself, don't hesitate. The 20-punch investment rule. Buffett believes that people would be better investors if they were given just 20 investment decisions for their entire lives. Imagine if every stock purchase required you to punch a hole in a limited 20-punch card. Would you still make impulsive decisions based on market hype? This mindset forces investors to think carefully, make fewer but smarter decisions, and focus only on the best opportunities. Why Buffett refuses to sell great businesses. Buffett isn't in the business of flipping stocks for short-term profits. He believes in buying and holding forever. Even if someone offers him 3 times the value of a company he owns, like See's Candies or the Buffalo News, he won't sell. For him, investing is not just about making more money. It's about owning businesses he truly believes in. This principle ensures long-term success, builds trust with his partners, and aligns with his personal values. How to find the true value of a business. At the core of Buffett's strategy is a simple question. How much cash will this business generate in the future? And is it worth the investment today? Investing is about buying future cash flows at a discount. For example, when you buy a government bond, you know exactly how much money you'll receive in interest. Stocks are different because their future cash flows are uncertain, but that's the challenge investors must solve. To evaluate a stock, Buffett treats it like a business. How much will this company earn in the coming decades? What is the risk of those earnings declining? Is the current price justified based on future returns? If he can't confidently answer these questions, he won't invest. Final thoughts. Buffett's simple but powerful advice. Warren Buffett's investment philosophy isn't about complexity, it's about discipline, patience, and common sense. Here's what you should take away from his strategy. Don't follow the crowd. Invest when others are fearful. Buy great businesses, not just cheap stocks. Understand what you invest in. Take advantage of big opportunities. Don't hesitate. Think long-term and hold great businesses forever. By applying these principles, you may not become the next Warren Buffett, but you'll be well on your way to smarter investing. If you found this video helpful, make sure to like, subscribe, and comment below with your favorite Buffett lesson. See you in the next one. Blast off.